What is it about what we heard from Trump yesterday? Laura, good morning to you. Do you think that has spooked the market so much? Is it the inaccuracies? Is it the lack of depth to the plan? What is it?
I think it's all of the above, really. I think market expectations were quite high for some kind of significant fiscal boost yesterday.
He'd called it major, hadn't he?
Yeah. So we did see that the European travel restrictions, which I think spooked markets, but as well, it was a lack of domestic containment measures and that focus on it being a foreign problem, that markets are potentially thinking that this spread has further to run in the U.S. And as well, the fiscal measures that we did see, so around the small business assistance, around the tax deferment, they're relatively small in scope, given what markets are really looking for in that type of significant fiscal package. And the fact that we've seen really just piecemeal approaches, markets are waiting for this coordinated action to really pack a punch.
Yeah, I like the metaphor. You know, Justin Sink from Bloomberg News wrote in this story that these are small bore solutions, which is to say, you know, you're using a pea shooter when the market wants you to use a bazooka. We throw around numbers like 50 billion, we throw around numbers like 200 billion, but the truth is, Laura, we're not really getting that much in terms of fiscal help from the U.S., are we?
No, and that's exactly the case. I mean, certainly we saw, you know, the Bank of England come out yesterday, and that's really the first one that's done a significant stimulus package that's targeted beyond just interest rate cuts. Now, expectations are quite high for the ECB today, but really a 10 basis point cut is probably the least that they can do at this stage, just to signal that they're going to take forceful action. We could potentially see other measures, but ultimately we do need the fiscal side to step up in this current environment.
And meanwhile, investors run for havens once again, running for the yen, running for treasuries. We thought maybe we'd seen the low on those yields, at least in the short term, if there was going to be some galvanization into action of fiscal players globally, and yet that hasn't happened. And so now we're back to those same questions about just how low 10-year yields go, I guess.
Right. And what was interesting actually yesterday was we actually saw yields rise despite this sharp equity rout. And so this is pointing to just the shortage of liquidity in the markets. So investors are looking to those liquid assets, those safe havens.
So selling
yesterday.
bonds.
They're actually selling the bonds.
In the same way they had to sell gold.
Exactly, for margin calls.
Yeah.
And we saw gold come under pressure as well. So today I would expect that the focus is going to shift back on just markets seeking protection again. But it's likely we're going to see these bouts of movements. But ultimately the trajectory, yes, for bonds is down.
So the how long can the bear market last question that you're asking on the MLIV, what kind of responses are you getting?
Well, I think when we look back at bear markets in the U.S., there's been about 8 of them since 1960. So on average, they last about 12 months. And on average, they declined by about 34%. So given where we are, just about 20% now for the S&P 500, the Dow is slightly more than that. This does point to further downside. And I think what markets are looking at now is just this exceptional bad news coming in, and the fact that we have to digest that earnings season is going to have to be significantly lower than what markets are currently expecting. So earnings are still in positive territory for 2020 expectations. That's going to have to come down quite significantly. That could lead to potential defaults and downgrades and further pressure on the credit market. So ultimately, I think it's too soon to say that we're out of the woods yet for the bear market.